Good morning, I'm Chris Beach, and welcome to Charting the Markets on IG Live at the start of a busy week for global markets. It is, of course, big tech week for earnings. We get Meta, Alphabet, Amazon, all reporting this week, and Microsoft as well tomorrow. So it really does get quite frenetic for global markets from here. We also have the ECB decision on Thursday. So lots of big events moving, or with the potential to move markets this week. We come into Monday's session on a very gloomy note, particularly in equity markets, of course, suffered really heavy losses last week, knocking them down in some cases to the lowest level since the beginning of September. In the case of the Dax, we're at its lowest level since March and April of this year. Really, really impressive losses across the board for stock markets on a cocktail of worries, of course, the war in the Middle East, but also the ongoing rise in bond yields, once again, really putting pressure on stocks for the time being. There might be no long-term correlation, particularly between the two, but there certainly is in the short term of people seeing bonds providing good income. They're not likely to put so much to work in stocks, and that's really putting pressure on equities as an asset class. And the rise in oil prices, the continued rise in oil prices, means that people are worried once more that inflation will keep rising. And last week we had a bevy of Fed speakers culminating in Jerome Powell, who obviously said that the bar for further rate hikes is quite high. And if you look at market pricing for the year, it does suggest that we won't see another Fed rate hike this year. But also they had to leave the door open for further rate hikes if the need arose, i.e. if inflation continued to be strong. Of course, the worry is for investors that with oil prices rising once more, we will see inflation readings begin to tick up, and they put that pressure on central banks to do more to fight inflation, even as economies, particularly outside the US, start to show real signs of slowing down. It is otherwise a very quiet day, however. Asian markets were weaker overnight, but it's something of an odd lull in the middle of what is a busy week. We do have the Chicago Fed National Activity Index today, but it's nothing particularly exciting. So we're just in the wait and see mode ahead of those big tech earnings and the ECB meeting later in the week. Starting with the indices, beginning for 200, 73.55 is the current level we're seeing this morning. And that is once again moving on below the lows of October and indeed early September. And you can see about this time last week, or not even a week ago, we were trading up at 76.70, and we were knocking on the door of the highest levels there since late September, and not really very far away from pushing to the highest levels since May. All that, of course, changed last week, and the sellers came in. The index dropped back below the 200-day moving average. It dropped back below trendline resistance from these February highs. How long ago that season? The index was up at 8,000 back then. Swiftly on Wednesday and down on Thursday and Friday, back below the 100 and the 50-day moving averages. And then on Friday came the culmination, breaking below trendline support from that August low as well. So the sellers very much in charge on this one. Back below 7,400 now for the first time, opening below 7,400 for the first time since late August as well. It might not be surprising maybe to see some short-term recovery for this, given the size of the move for the FTSE 100. That's a big drop of about 300 points in a week. So maybe some consolidation is the order of the day. But as you can see, there's not much now to stop the index if it continues downwards before it reaches really these July and August lows at 72.30 or so. Those are the lowest levels there we've seen for the index there. And that also coincides nicely with this area, and it's a very wide area of support we had in March during that banking crisis, when we did briefly go all the way down to about 72.07. So a big area of potential support, I think that's the best way to describe it really, for the index coming up if we do see further losses. A bearish view, of course, very much in place in the medium to long term, I suppose, looking back towards February with this trendline resistance having held back progress for the index. One maybe hope for the buyers will be if we get a close back above 7,400, because that's where they stepped in September and October. So if they could do that again for the third time, maybe there's hope for at least a short-term bounce back towards the 200-day moving average. For the DAX, there's not even really that consolation. I think we are back at the March lows for this index, 14,700, indeed moving below that in early trading, testing levels we haven't seen since the crisis around Silicon Valley Bank and the fall of Credit Suisse, if we can all cast our minds back that far. Bearish view, really, had we but known it, of course, that all-time high for the index on the 31st of July, followed up by this decline. Nonetheless, still firmly high on where we were a year ago. So I think it's still a testament to how big that rally was from the October lows to see this pullback into what is seasonally a tough time for the index anyway. Nonetheless, it's not much consolation for the buyers to look at that longer term picture, given the losses we've seen and really the break below the 200-day moving average in the second half of September, the failure to get back above it, and then you get the 50-day as well crossing below it. Really seeing sellers pile in on this one. No sign really of any stabilization even, and certainly not one of a turnaround just yet. So really the next thing is, well, worth watching this area that we're now heading towards rapidly, because not only was around 14,500 or so, because not only was that the low around the banking crisis of March, but it was also, interestingly enough, where the index first sort of faltered in its rally during the course of November and into December of last year. Huge rally from the October low, and then we hit this area, 14,500, an air pocket, if you like. We dropped about 1,000 points in the space of about 2 weeks, and then we rounded again. But this is clearly an interesting area to watch, where buyers have stepped in March, where sellers stepped in November of last year, and indeed looking back to the beginning of June last year as well. So there's whatever it is around 14,500, it's definitely an area to watch, and that's the best way we can phrase it at this point in time for the DAX. Going to the US and Dow, Wall Street on the IG platform, of course, back below 33,000 once again. So essentially revisiting where we were at the beginning of October. It's hard, of course, to muster up much of an optimistic view on the Dow. Not the greatest year for the index, left behind by the likes of the NASDAQ and the S&P with its heavy weighting towards tech, doing better than the small cap Russell, has to be said. The Russell really having a miserable year overall. But the Dow essentially back into this potential area of support that we saw in late May around 32,700, which the last time it was here, it then enjoyed a rally right to the peak of August at 35,000. So there is perhaps reason for optimism on this one even now. Not blindly, but certainly worth watching this level as we get to it. Buyers did also defend 32,900 at the beginning of the month. So there's another sort of a confluence of potential support coming through there. Short-term bounce would inevitably target the 200-day moving average, and then on to the 34,000 LADV's highs from the middle of October, around about 33,980. An interesting point to watch. Get back to there, and maybe we'll have to be there'll be certainly, if we do get back to there, rather, that will be the thing to watch, really. And that's all, of course, technical analysis is. We're not trying to predict the future. We're just trying to say these are the levels that were important before, they might be important again. It's clear from this, you can see that if we do rally, 34,000 is the area to watch on the upside. If we do continue to drop into the beginning of this week, ahead of tech earnings, which wouldn't be surprising at all, then these lows from the end of May, around 32,700, will be worth watching as well. Not much in the way of moves or certainly data to drive FX markets this morning. As you can see with euro dollar here back above 106, we are seeing a bit of short-term dollar weakness, euro strength, call it what you will, ahead of the ECB this week. So we are moving higher for the third session in a row here, euro dollar. And crucially, in an interesting development, as about as exciting as technical analysis gets, we've managed to move back above trendline resistance from this July high. This very steep, very strong area of resistance that has held since the euro peaked against the dollar at 112.80 in the middle of the summer. Unsurprisingly, given the scale of the downward move, it's bound to happen at some point if we get consolidation and then a short-term rebound. But the bearish view certainly very much in place here, unless and until we get back above the 50-day moving average at least. So any close, I think, any sort of rally that falters below the 50-day, below 107, could sort of spark fresh selling. I think we're then entering as a potential lower high. We've also got this area of probable resistance now on the way up, because of the support on the way down during June, around 106.70. So anything that really fails to get back above there could fall firmly into the lower high camp and see selling pressure piling once again. That trend line's been broken, but that was the kind of thing we expected to happen anyway, because it was so steep. More interesting thing is to watch what happens if the price does start to rally. Can the ECB be hawkish enough to turn euro dollar around, or will we simply get another sort of calming statement from them, which leaves open the possibility for more rate hikes but doesn't do anything about it, in which case you might well see the dollar start to take over once again and euro dollar start to fall. For the pound against the dollar, we haven't even got the consolation of a decent rally, because we're still well below trendline resistance from the July highs of this currency pair. as well. Not rolling over yet. We're still seeing some buying coming in around 121 after last week's data-heavy week in the UK. We do get unemployment data tomorrow. We were supposed to get it last week, but the ONS delayed it by a week. We just got the wage data last week, which arguably is probably the more important at the moment anyway. But we get unemployment data for the UK tomorrow, so do be aware of that one if you're trading the pound in any of its forms. Short-term bounce perhaps towards trendline resistance would be entirely unexpected, maybe as the dollar just weakens in the short term, but as with euro dollar, very much a bearish view in place here. You've got 50-day crossing below the 200-day. The price is well below the 200-day moving average on the rally in early October, then hit firm selling. So I think we're still watching, waiting for a close back below 110 to open the way for a fresh leg lower. Although if we do get a bit more of a sustained rally, trendline resistance coming in towards 122.70 is a thing to look out for. Finally, dollar yen, not much to report on this one, but obviously it's such a popular currency pair that we can't not talk about at the beginning of the week. Still knocking on the door of 150, but without any apparent desire to go higher. But that doesn't mean it's now a selling opportunity, because clearly there's no price action to support that view really at this point in time. We might get some intervention from Japan at some point if this one crosses 150 again. And that might then see us target the rising 50-day moving average at least. We've not really had a decent pullback in euro dollar since early July. So one is overdue, and that's the kind of thing analysts say when we don't know what happens next. But I think it's a thing to bear in mind that if we do see a pullback, it would be entirely consistent with an uptrend and would not really damage the overall bullish view. But we still can't close above 150, and that's the thing to watch out for. This could go on for quite a while because the market needs to be almost daring the Japanese Ministry of Finance to do something. At the moment, they just don't have the courage to really push that one far enough. If we get a close above 150, that might be the trigger and might provoke another downward move. For context, of course, that's what happened in June and early July, that you had intervention and it drove the price down. It did it for only about 2 weeks, but it was enough to push that back again before it started the rally. So maybe that's the kind of reaction we're expecting once again for dollar yen. And then we come to commodities, quite the most exciting place to be in global markets over the past couple of weeks. Gold going from that 1820 low back, knocking on the door of 2000, although not quite there on Friday. We're back at the highs we last saw in mid-July, around 1980. Unsurprising, maybe that just ran out of momentum there on Friday after the huge gains we've seen. But if you look at the hourly chart, it's a very, very elegant uptrend. You're still seeing higher highs and higher lows, still dominating that really. Buyers came in this morning right on cue at the 50-hour moving average, pushing this one higher again. So short-term trend still very much higher. You'd have to see the lows from yet today breach and then back below really 1950 to suggest that maybe a turnaround could be at hand, at least in the short term. And I think it'd be more consolidation than complete reversal, although anything can happen, obviously. Maybe pull back the drifts back down towards 1930 and 200-day moving average is the kind of thing bulls would like to see. There's certainly maybe a sense that it's looking a bit overstretched in the short term after this huge bounce, but consolidation rather than massive drop is probably the more likely outcome. But 2000 still within touching distance, and you can sort of feel the desire to get back to that psychological number. Everyone loves a good round number. 2000 no exception, and that's could be where we see gold heading before it maybe pull back to the short term, pulls back in the short term. Something to look out for really. And then oil prices, again, not quite as spectacular as gold in their rally last week, but nonetheless, remember what we said about dollar yen and uptrends asserting themselves after a pullback. That's exactly what we had here. We were looking again. It looks overstretched is the other kind of thing analysts say when it's gone up a lot. We're not quite sure where it goes. But eventually the pullback did occur. We'd had one in August. We then got one just as September gave way to October. We saw quite an impressive drop, but buyers then came back in again. You recovered the 50-day moving average and saw the MACD decross higher. It's just the kind of thing you want to see in an uptrend in any kind of asset, any kind of price chart. And that's just what we got here. After huge gains in 3 days last week, just a bit of consolidation. But again, if you're looking at the hourly chart, recovery here, higher low, 3 higher lows in a row. You can't ask for more an elegant chart to couple, especially with 3 higher highs. It's poetry in motion where technical analysis is concerned. And that's just what we've had. Some buyers coming in this morning, getting back towards the 50-hour moving average. Further gains, of course, targeting last Friday's highs, at least in the short term. So as I say, just the Chicago Fed National Activity Index on the calendar for today. That's as exciting as it sounds. Really, it's not going to drive markets particularly, but we've got big tech all the way through this week. Earnings coming from Microsoft, Alphabet, Amazon, Meta, all after the closing bell on their respective days. So do watch out for some volatility around the close and beyond it as those earnings come out. It's supposed to be a fairly gloomy day on US markets. Not quite as gloomy at the moment as Friday, but still fairly unappetizing for the buyers. The Dow expected to open the day down around 150 points lower from Friday's close. That's it for me. Thank you for joining us. And we will see you again tomorrow at 10:30.